So Paul, should we begin on time?
Yeah, let's do it.
All right. So good afternoon, everyone. I mean, it's afternoon in Miami. I don't know where you are. So hello, and welcome to this very eclectic yet very exciting session that will talk about behavioral issues and machine learning, and then go all the way to microstructure issues and machine learning. So we're gonna cover a lot of stuff. And our first paper is by Miao Liu, and that's going to be the behavior of loan officers in China. Very exciting paper. Miao, please go ahead.
All right, thank you, Angie, and thank you for the conference organizers to invite me. It's truly a great opportunity and an honor to be here. This is actually the dissertation I wrote at University of Chicago. Let me jump into the paper right away. So we know when firms disclose information to the market, oftentimes the objective is for that information to be useful for investors to make a decision. But how much that objective is met depends on how efficiently investors process that information. The research question of this paper is to study what factors determine the efficiency of information processing. And in particular, I studied this research question in the context of credit information processed by loan officers when they make lending decisions. I find it useful to kind of organize the literature into two broad categories. The first is cognitive constraints. The central prediction of this literature in terms of information processing by investors is that people can only process a subset of all useful information because they have cognitive constraints or limited attention. The second broad category is the behavioral bias literature. And the central prediction there is that even within this set of information actually used by investors, they make systematic probabilistic errors. However, we have a separate literature in finance and in accounting that predicts and emphasizes actually investors have the strength to discover new information. So taken together, it seems we have a trade-off here between the quality of information processing and the quantity of information, total amount of information discovered. Okay, so let me jump into my setting. It is I have detailed loan level data from a major small business lender in China. And there are two types of information. First of all, there's a hard information about borrowers' demographic and accounting. And second of all, there is soft information that loan officers collect from the borrowers, mostly from phone calls. And on top of that, hard and soft information, they interact in the sense that when determining whether and how much soft information these loan officers want to acquire, they make that decision after they observe hard information. And with this setting, my paper asks two research questions. First, which factors impede loan officers from processing hard information efficiently? And two, how these factors further affect soft information acquisition. To give you an overview of my main results, I first train a machine learning model and show that this machine learning model substantially outperforms loan officers in processing hard information. And then I use this machine learning model as a benchmark and find that loan officers can only process a subset of all useful information identified by this machine learning model. This result is consistent with the prediction of the cognitive constraint theory. And second, loan officers also overreact to salient information comparing to the machine learning model. This result is consistent with the prediction of behavioral bias theory. However, loan officers, they acquire more soft information after they see salient hard information. Putting these results together, there seems to be a dual role of salience. on the one hand, it creates bias in processing hard information by attracting too much attention to it. But on the other hand, it also facilitates the discovery of soft information by signaling where to pay attention. So in a way, that human weaknesses in processing hard information breeds their strength in acquiring new information. Let me jump into some of the details of this setting. So the data provider is a small business lender in China that operates in 23 cities. And I have the entire history of loan data from this lender. The average loan size, converting to US dollars, is about 8,000. So they are small loans. And the maturity is usually between 1 and 2 years, short-term loans. The profit of the lender is 15.6%, which is the difference between the overall revenue generated by the loans and the loss from defaults. And across all the sample, I have more than 50,000 loans made by more than 50 loan officers. A key feature on this market, which is very common, not only in China, but also in some other countries, is that interest rate and fees are fixed for all borrowers. The reason is that for this type of small business lending market with high-risk borrowers are much more sensitive to whether they can get a loan than to this particular price if they get a loan. And the loan officers make two decisions. One, whether to grant or reject this loan. And two, conditionally on granting the loan, how much we should lend to the borrower. All right, here's a graph that shows you the decision process of this lender. First of all, we have a borrower, I, filling up a loan application and entering the system. And the system is going to randomly assign this borrower to one of these loan officers. And this loan officer on the left-hand side going to observe what I call the hard information. That consists of either demographic information or accounting information collected by field employees sent by the lender to the borrower's business stores. And on the right, we have what I call soft information. Sometimes these have pictures taken by the field employees about the borrower's inventory, business receipts, etc. And more often, soft information comes from phone calls made by the loan officer to the borrowers or the borrower's co-workers or the borrower's family members. And based on the hard and soft information, the loan officer is going to make a lending decision, which I call the loan size, to borrower I from officer J. Two institutional features about this setting that facilitates my study are: one, I observe the entire hard information set loan officers use. And two, borrowers are randomly assigned. What this random assignment buys me is, if you think about two officers make systematically different decisions, there are two possibilities. One is that these two officers, they process the same set of information in different ways. And the second possibility is that they simply assigned different types of borrowers. And this random assignment helps me to rule out the second possibility and allowing me to focus on studying information processing. Okay, so here are some examples of what kind of information these loan officers observe. So on the left, we have demographic information that basically explain themselves. On the right, we have what I call accounting information, including buyers, suppliers, accounts receivable, accounts payable. These kind of information are collected by field employees from the lender when they visit borrowers' business stores. And we also have cash flow type of information that show up on the borrower's bank statement. All right. Let me talk about my research design. This is an overview. So right now we have loan size. And then later on, we observe how much the borrower repay. So these are data, my data. But how do we evaluate whether this loan size decision is a good decision or not? We need a benchmark. Such a benchmark is usually easy to find if we run an experiment in the laboratory. But since I'm studying in a real world setting, we don't have that benchmark. My solution is to train a machine learning model based on borrower's hard information set X, and let me call that machine learning model M. And the purpose of this machine learning model is to predict how much the borrower I is going to repay their loan. And then I use this machine learning model. I ask it to make a machine-based decision, how much money that this machine would be willing to lend. Call that decision loan size M. And if this machine-based decision generates a higher repayment on average than the actual repayment from human decisions, then I can say this machine learning model would be a useful benchmark to evaluate human information processing. But there's one complication, which is if you look at this human decision, it's not only based on hard information, it's also based on soft information. So if I want to use the machine learning model as a benchmark to evaluate loan officers' hard information processing, I need to take care of this soft information, which is not available to the machine. The way to solve this difficulty is to decompose this human decision into two parts. The first part, X, is how much of this human decision comes from hard information processing. And the second part, S, is how much this human decision comes from soft information processing. The way to perform this decomposition is to train a second machine learning model, but this time not to predict repayment, but to predict loan officers' decision based on hard information. So in a sense, since I trained the second machine learning model officer by officer, in a sense, this set of machine learning models are mimic of each loan officer's hard information processing behavior. So once I have this second set of machine learning model, the difference between the real decision and the machine predicted decision is going to be my soft information. So with that, with all these techniques, this paper is about, first of all, use this the first machine learning model as a benchmark to evaluate human decisions in processing hard information. And two, study how these errors affect soft information acquisition. All right. So let me zoom in a little bit into this decomposition, talk about the pros and cons. I would say that there are two strengths of this approach. First, this approach allows different loan officers process the same hard information differently because I train a machine learning model for each of these loan officers. And the second strength is that officers, they can process hard information in any nonlinear fashion. This is the power of machine learning model, to capture in a data-driven way to capture any nonlinear feature of the data. But there are some caveats with this approach too. The first is that if you look at this decomposition, I have to assume that hard and soft information are somewhat separable. But in reality, it's quite plausible that soft and hard information might interact. And when that happens, some of the signals in the soft information S will be captured by the function H. So I would say this approach will only give me a lower bound of all the soft information existed in the data. The second caveat is because the soft information part S is essentially a residual, And we know that residual has a mean 0. So this approach is not going to give me the average effect of soft information. It will only give me variation of soft information across loans and across loan officers around the mean 0. And the third caveat is that, again, because I'm using this residual approach, the soft information S is going to pull both signal and noise. So it is essential for me to kind of evaluate whether all I'm capturing in S is just noise, which brings me to this graph. Here, each point is a loan officer, and each point is on the x-axis. It is the standard deviation of all the S within one loan officer. It is a measure of how much soft information that a particular loan officer generates. And you can see this measure of soft information acquisition skill is positively correlated with profits generated by loan officers and negatively correlated with defaults. So this is an evidence that the soft information that I capture cannot be just pure noise.
Meow, about 5 minutes.
Got you. So let me jump into results. The first result is that if I compare the performance of my first machine learning model and human performance, I find that the machine learning model, which is the gradient boosted machine here, outperforms by 38%. And as a benchmark or a reference point, if I were to train the machine learning model using OLS, it doesn't outperform loan officers. So this result allows me to use this machine learning model as a benchmark to evaluate human decision errors. The first type of decision error I explore is from this cognitive constraint theory, which predicts that loan officers can only process a subset of all useful information. In these two graphs on the left, I regress this human decision, mimicked by the second machine learning model, on the full set of hard information sets. And we can see how many hard information variables are actually used by these loan officers. And among a total of 205 hard information variables, loan officers only use between 30 and 60 of them. And the bottom, this is the blue bar at the bottom, is how many variables are identified as useful predictors by this machine learning model. And there are much more hard information variables identified as useful by the machine learning model, but actually not used by loan officers. This result indicates that loan officers have very limited attention. And if there's any attention allocation device, that would be very valuable. The second theory is behavioral bias theory. And that tests a particular type of this theory that called representativeness bias. It predicts that humans overreact to salient information intuitively because it catches the eye. Here, the y variable is a measure of misranking. It equals to 1 if a loan officer ranks a borrower at least one decile away from the machine learning model's ranking. And salience is a dummy that equals to 1 if a particular accounting variable falls into 5% left tail of that variable across all borrowers. As you can see, loan officers are much more likely to make mistakes when a borrower has salient information. And the final results is whether this salient bias affects loan officers' soft information acquisition. And here, I find that soft information generated from the salient sample actually brings to the lender more profits. So what is the intuition here? The intuition is that salience kind of serves as this attention allocation device. it tells the loan officer where to pay attention. For loan officers, it makes much more sense to make a phone call to a borrower and ask why your cash flows are so jumpy than to make a phone call to a borrower and ask why your cash flows are so smooth. To sum up, efficient financial reporting requires efficient information processing. In this paper, I developed a framework to evaluate information processing using machine learning model as a benchmark. I find that loan officers can only process a subset of all useful hard information, and they also overreact to salient hard information. However, loan officers acquire more soft information after they see salient hard information. So in a sense, salience has this dual role. And first, that it creates bias in hard information processing by attracting too much attention. But at the same time, it facilitates soft information discovery by signaling to humans where to pay attention. So in a way, that human weakness in processing hard information and their strength in discovering new soft information are sort of two sides of the same coin. Thank you.
Thank you very much, Miao. I am the discussant, and I would like to share my screen. Let's see where that is. So hopefully you guys can see my slides.
Yeah.
All right. Of course, my slides are not cooperating. Oh, great. Just 1 second. My slides are not cooperating for some strange reason. You know what? Let me just go through them like this, because it'll take too much time to deal with it. So first of all, Paul and the rest of the organizers, thank you so much for the opportunity to be at this conference, although not in Miami, which is the sad part, and for giving me Miao's paper to discuss, because as a microstructure person of my age, I tend to only read market microstructure. And when a conference like this says, why don't you discuss a paper that talks about behavior of loan officers? You first go, And then once you read it, you realize how interesting this stuff is that your colleagues do in other fields of finance. So I really appreciate the opportunity. So this is a super cool paper that basically asks the question that I think a lot of us are asking ourselves and a lot of policymakers are asking, and that is, are machines better than humans? And in this particular paper, the question is a little bit more pointed in the sense that it asks if the machines are better than humans in evaluating loans. Can you guys see my slides moving? Yeah, okay, great. And the answer is yes, the machines are 38% better, which is sad and scary to some of us and maybe to some of our students, but let's continue talking. And of course, Miao's main goal is not to document this one number, it is rather to try and understand why, right? So the reasons for us humans to underperform the machines, well, there are two. So the first of all, there's limited cognition. It turns out that out of 200 something variables that these human loan officers have access to, they only really look at a third of available variables. And the machine looks at everything that's relevant. So it's better because of that. And also, it turns out that humans overreact to salient information in the sense that when they see something that's out of the ordinary, let's say a cash flow that is too low or a change in cash flow that is too large, they tend to focus on that and ignore other important issues. And that, of course, also hurts the performance of the loans that they eventually end up originating or denying. Humans do one thing well, and that is extract and analyze soft information. So the machine is not great at doing that. And Miao sort of spends a lot of time in the paper sort of parading this result. And at first, it also gave me hope, but at the end of the day, when you start looking at the numbers, you realize that even with our ability to process soft information well, or better than the machine for that matter, we're still 38% worse than what the machine can do. So at the end of the day, Meow says, look, maybe we should let the machines process hard stuff and then ask humans to do that top up of the soft stuff. That's in the appendix, so that's not the main goal of the paper. And of course, the paper is hitting more the theory that is relevant to these issues, and I'm kind of hitting the results that I found very, very exciting. So this is a very well written, very detailed, very mature paper. I assumed it was Meow's job market paper when I was reading it, but then he confirmed it at the beginning of his presentation. So he has heard from a lot of folks who are actually in this field, and I am sure took their comments to heart. So my comments, I have three sort of sets of them, are those of a person who is definitely not in this field, but is really excited about the results here. So take them as they come. So the first set of comments have to do with this cognitive constraint. It is sad to see that we are not as good as the machine. But then the questions come up that I would like to have some answers to if they're available, or maybe for Meow to think about for his next project or series of projects. So first of all, the first thing that comes to mind is non-discrimination legislation. So a lot of data that the machine is allowed to look at has to do with things like gender, age, marital status of the loan applicants. And I'm not sure about regulations about this stuff in China, because the paper is based on Chinese data. But if this were done in Canada, then these loan officers would probably have a very hard time basing their decisions to give loans or not to give them based on, let's say, gender of the applicant. So my question to Meow is, to what extent the machine does better than humans, because the humans are restricted in terms of what kind of information they're actually allowed to base their decisions on. The second question I have, and this all kind of goes with the cognitive constraint part of the paper. The second question I have is that I was quite surprised, and again, this is not the area that I usually study, but I was quite surprised with the fact that the bank or the lending company that is the subject here has absolutely no guidance for these loan officers in terms of how they should be evaluating loans. This is what the paper explicitly states. So my first thought was, well, so basically they get hired and then they're just given these loan applications to evaluate, and they just do whatever they want. That sounds a little bit too far-fetched. So my thinking went into maybe there are unofficial approaches that the company has and that the officers are aware of, but they're not officially stated. Maybe the officers receive training before they get the job. Maybe it's training outside the company. Maybe they have to pass a certification exam before they become a loan officer. Maybe that is what's driving their decision to base these loans on a certain subset of available information. So any sort of guidance on that Meow can give the next reader, I think would be really useful. My third point in this first comment has to do with the time. So at the very end of the paper, the reader learns that these officers have about an hour to evaluate each of these applications. And you start thinking, okay, so there's an application that has 200 variables in it. These are hard-coded sort of Excel spreadsheet sort of variables. But then what else does it have? Does it have a long letter from this aspiring person who wants a loan explaining why they want it and what they're going to do with the money? And if that's something that the officer has to read and how much time it takes to read that. And then does the officer have to write a report about the decision and how much time does it take to do that? Given that they only have an hour, if these applications are large and the reports that have to be written about them are long, no wonder they don't look at all 200 variables, right? So is it a truly cognitive constraint in its purest sense, or is it a time constraint? So any sort of information on that, I think, could be potentially interesting in our understanding of how is it that we are so bad as humans analyzing this information. My second set of comments, and Roberto, if you're timing me, I know that I have about 2.5 minutes left, so thank you.
Yeah, you have 3 minutes.
Oh, good. Okay. So my second set of comments has to do with variables. You remember probably from Yao's presentation that he divides these variables that the machine and the machine is looking at. The humans are looking at into hard and soft information. And hard is what's coded in the spreadsheet, I'm assuming, and soft is that je ne sais quoi, as they say in France, in terms of, you give a call to the borrower and then you kind of get a feel for what kind of a borrower they might be. And the way the paper defines soft information, because that's unobservable, is as a residual. In other words, Miao estimates sort of what kind of information was used, then he knows what part of it was hard, and then whatever is left is soft. And my thinking went in the direction of what else can be in that residual, and the primary suspects came up in my mind as macro or sort of some sort of forward-looking industry knowledge. Let's say I'm evaluating a loan from an agricultural firm. I have a pretty good idea, I guess, of what to expect from this industry over the next few months or years. It's not in the spreadsheet. It's probably not the data I got from the borrower, but it's hard data. It's not soft data. So my next question to Miao is, if he knows, or maybe there is a way to kind of benchmark that, to what extent that hard or not soft information is actually part of the current estimate of soft. I think I have only a minute or so left, so let me go to one last comment, which is the last thing on this slide. So after reading the paper, and like I said earlier, the paper is extremely well written. It's beautifully written, but I wanted more. I just wanted more on pretty much everything that Miao does. And for example, there are 205 borrower characteristics that are that hard information from the spreadsheet. The machine looks at 147 of them. Humans tend to do no more than 56. What are the variables that the humans are missing? I understand that this is not this paper, but I think that the next paper that I would love to read would try and understand what is it that we're actually not getting right as humans, and the machine does. I also couldn't necessarily figure out exactly what these variables are, because table 1 sort of lists them, but there isn't enough in table 1 to come to that number 205. So I am just basically starved for information about the data themselves and what exactly is it that's wrong with us humans when we look at the data and try to evaluate loans. My third set of comments is technical and probably only interesting to Miao, if even to him. So I'm going to skip that and go to my conclusions. So this is a very interesting paper, a very sad paper in a sense, because we all know that the machines are slowly taking the jobs that we as humans used to do. And this paper very cleanly shows how and exactly what kind of jobs may be next. I talked to my brother, who is an analyst in New York yesterday, told him about this. He's like, nah, that's never going to happen. Well, we'll see. So anyway, very interesting paper, beautiful work, and I recommend that all of you read it. Thank you very much. Now, no one is saying anything, and I don't see any questions. Oh, actually, I have a chat. Oh, no, that's a chat from Paul. So looks like there are no questions. Miao, do you want to take just 1 minute, if you want to, and respond, or should we move on to Roberto?
Can you hear me?
Yes.
Okay. So first of all, I just want to thank you for such a wonderful discussion. And if you can send me your slides later on, that would be so appreciated.
For sure.
Right. So just to respond, maybe some of your main points, I can try to think about the best way to show what type of information that humans are more likely to missing and captured by the machine. But so far, I don't have a clear mind on the best way to do that, because these machine learning models, they pick the variables at the most predicting power, but not necessarily the variables that that make the most sense to humans. So it's if there's a variable missed by humans but picked up by machine just because they have, for some non-good reason, that have better predicting power, then it's not I don't quite know what kind of economic message that we conclude from this difference.
Yeah.
So this is something that I'm working on.
It's great to hear. I would love to see the results. Okay, so let's switch over to Roberto. Roberto, please take it away.
Let me share my slides, share screen. Oh, I have so many things up. This one. So I think you can see my slides, right? Yeah. So thank you very much for including this paper. I'm very excited to be virtually in Miami. So basically, central banks today, for those that are not familiar with this literature, pay a lot of attention to its communication with financial markets in an attempt to shape market expectations. And the reason for that is that it's well understood that the effect of monetary policy on the economy today not only depends on the current policy actions, but also on the EN's expectations about what is going to do the Fed next. And this is known as forward guidance, and it's a key tool for central banks. And the answer to this question is, so here, for this particular reason, it's important to understand how economic agents form expectations and how these expectations change when faced with individual messages coming from the central bank. So here the idea is when the central bank or when the Fed speaks, how agents react to the words spoken by the Fed. And the answer to this question is particularly relevant given what's the current stance from a large macroeconomic literature that shows that there are substantial information rigidities by professional forecasts that try to forecast, I don't know, GDP or something like that. So that is, they update their forecast too slowly relative to a full rational expectation model. So what we do in this paper is we provide first granular evidence on how the agent's expectation change when faced with individual words coming from the central bank. So here the idea is we will first identify the individual messages that the central bank sends and how markets react in a narrow window around this message. And the main takeaway of this paper is that investors seem to fail to fully incorporate the central bank message, and we will show you that this failure is economically large. And the way we'll do it is we will propose a simple trading strategy that trades based on the information sent by the central bank, and then we will look at the profits that the strategy makes. So here the profits will tell us something about how large are these information rigidities that we are documenting. So before I describe the main empirical results, let me just briefly explain you what we think is the methodological contribution here, which is, okay, how can we identify these individual messages coming from the central bank? We will take as a laboratory the days in which the Federal Open Market Committee has a scheduled meeting, and we will focus on the post-meeting press conference. So here the Fed chairman holds a press conference, and we will extract the videos from this press conference. And from the videos, what we care about in this paper is the words spoken at each particular point in time. So we take the audio from the videos, and then we split the audio frames into 3 seconds. And why we do that? Because now we know exactly in which 3 seconds each words were said at each particular point in time. So once we have the words, we just transcribe it into text, and then we will know exactly the words spoken at this particular point in time. Then you can just append all of these different words and then align it with high frequency financial data to see to which words the market is reacting. So here we have a very nice link between the specific message sent and the signal received. And so let me show you how our data set looks like. So here we have the exact starting time, the exact ending time, and the words spoken for three seconds. And we think this is a nice contribution to literature because it broadens the type of questions we can ask, given that we have higher identification. So what we do in this paper is we consider all press conferences. So our data set will look like that, like a panel of this. And what we will do is we are going to extract common messages out of this press conference and then see how, on average, markets react around this common message that we are able to identify. So let me very briefly explain you with a simple day, what happened in a specific day to highlight our contribution, our empirical contribution, and then I will extend it to all press conference and to a wide range of financial assets. So let's take, for example, the day of July 31, 2019. So here, this is a day of 2 events. First, at 2 p.m., we have the FOMC statement release. So usually, for those that are not familiar, the Fed releases one PDF document with changes, with what they think is the view, with the current change in policy and some words describing what is their view. Half an hour later, we have the press conference, and usually in this press conference, the Fed chairman discusses things put on the statement. So at 2 p.m., you can see that there were two pieces of information in this PDF document that was released sharp on 2 p.m. The first one is these words that the committee decided to lower the target range of the federal funds rate by 25 basis points. That's the first piece of information. The second one is, if you look very carefully, they changed some words. So they got rid from the words in red and they added the words in green. So basically they put, as the committee contemplates the future path of the target range of the federal funds rate, it will continue to monitor. So basically this is the new information that arrived to the market. So what we are going to do is we are going to consider all statements and we are going to extract these words, the changes that they added in each statement, and then we will look for these patterns inside the press conference to see how markets react towards these changes. So let's see what happened, for instance, for the exchange rate euro against the dollar. No, actually, this is how our data set looks like. So here during the press conference, what you could see is that there is a back and forward between reporters asking for clarifications about this statement and Powell, which is the chairman in this press conference, trying to clarify. For instance, minute 5, here a reporter from the New York Times asked, okay, per your statement here, I guess the question is, what did you really mean by this change in green? And Powell replied, okay, we are thinking of it as an essential in the nature of a mid-cycle adjustment policy. Then a reporter from Wall Street Journal, where is the bar right now? Because I think there's some confusion about how the committee is responding. And so you can see this back and forward between reporters asking for clarification about this statement in green and Powell trying to clarify what they actually meant, what we should take this to mean. So what we do in this paper is we are going to extract all of these references in the statement during the press conference and then align it with high frequency financial data. So let's see what happened with the euro against the dollar. And so here we are plotting it. So here we have second level asset prices. On the x-axis is the time during this day. So here you have, and on the y-axis is euro against the US dollar. So here, if it goes down, you have a dollar appreciation. So you see at 2 p.m., the dollar appreciated. And the reason why the dollar appreciated, even though the Fed cut rates, is because market participants expected a higher rate cut. So here, during this half an hour, you have a quiet period. There is nothing much. And here, the shaded area documents the entire duration of the press conference. And in red, the dotted red lines are reference to the statement. So here you can see two things. Every time they talk about reference changes, prices move a lot. So here we have huge price volatility on average. And the second very interesting finding is that prices move on average in the same direction as they did around the statement release. So, and once you accumulate all of these price changes inside the press conference, you see that the average change inside the press conference is of similar magnitude as the price change during the statement. So here the message was, the message or the signal received by market participants was that there was no plan for a series of rate cuts. So if you got this, like basically the rest of the paper, we document this, that it holds for all press conferences and it holds for a wide range of financial assets. So let me summarize the empirical contribution. So here we document that when the chairman discusses changes between consecutive statements, price volatility and trading volume spikes dramatically. And something very interesting is that prices move in the same direction as they did around the statement release. Once you accumulate all of these price changes in the press conference, you can see a very strong correlation between price changes around the statement and the subsequent press conference. Just to put some numbers here, the correlation is 40% for medium-term Eurodollar futures, or 44% for the ETF that tracks the underlying stocks of the S&P 500. And then once you see these patterns, you want to see how, if they are economically large or they are statistically significant. So we propose a trading strategy that trades based on this information to document how big are these changes. And then the final question is, what can explain our findings? So here we evaluate 7 potential explanations that are documented in the literature. We are able to reject 6. and they seem to be broadly consistent with canonical models of information rigidities. Specifically is that market participants are only able to understand the Fed words with some noise. And then we showed that once this is the case, this will lead to these interesting patterns that we are documenting inside the press conference. So the outline will be, I will just show you very briefly what is the relationship between price change around the statement and the press conference, which is what I showed you with the Eurodollar. Then we will go inside the within press conference analysis to try to understand which instances give rise to this very strong pattern. And then I will not have time to discuss some explanations about this pattern in the data. So let's dive into the first result. So here, what we are going to do is we are going to compute price changes around 2 time periods. So here is time periods around the statement release and time period during the press conference. So here, our identifying assumption is that information that is driving prices during this time window is basically driven by the information released by the Fed. So here, what we do is we will just run this very simple Euler regression where we here regress price changes inside the press conference onto price changes around the statement. And here, what we care about is this coefficient lambda, which will tell us something about this relationship. So before I show you the Euler regression, let me show you how the prices look like. So here we have a scatter plot of the Fed fund futures from 3, 6, 12 months. For those that are not familiar, usually if market participants want to express their view about what is going to do the Fed with respect to the Fed funds rate, usually they will trade with the Fed fund futures. So here I plot the scatter plot. On the x-axis is the statement, y-axis is price change around the press conference, and for 3 different maturities. And something very interesting is that this relationship is stronger and stronger the higher the maturity we go. For instance, if we want to express for 12 months, you see this relationship, we can go to Eurodollar futures and you see stronger and stronger relationships. So this for us, what it means is that if they are learning something, it's more about what is going to do the Fed in the next 24 months or so, not what is going to do in the next FOMC meeting, given that we don't find strong relationships here. So once we see this pattern, so in this table, we just put the statistical significance here, where the lambda coefficient, you can see that it's very similar across different asset classes. So here we consider Fed fund futures, Eurodollar futures, stocks, and a bunch of Forex. And the second thing is that the R square is quite high. For instance, for Eurodollar futures, an R square of 20%. And just remember that this is a predictive regression. So basically, we're predicting what will happen in 220, what will happen to price changes 1 hour in the next hour. So given these strong patterns in the data, we just wanted to assess the economic relevance. And the way we'll do it is using a trading strategy. And this is the simple strategy that we could come up with. At the start of the press conference, what you will do is, before Powell starts talking, just look at what price changes did around the statement release, which happened half an hour later. If they go up, then you just buy. If they go down, then you can do 2 things. You can take a short position. If you're not able to do that, just stay out, don't do anything, just don't buy it. And then at the end of the press conference, just close your position. And the nice thing about this is that it doesn't require any parameter estimation. You just need to have access to high frequency data to see what happened before. So in the paper, we have a bunch of statistical measures that try to measure this profitability. But for now, I will just show you the cumulative performance of this strategy inside the press conference and for 3 different assets. So here on the y-axis, we have minutes into the press conference. So minute 0 is the exact starting time when Powell starts to talk. And then the y-axis is just this cumulative performance of $1 invested in basis points, and I just normalize it such that it starts at 0. And what you can see is that, and this is the blue line, this is the market timing strategy that conditions on price changes. And the red one is that it's just a buy and hold. Regardless of what happened statement, you just go long. And what you can see is that this market timing outperforms. And just to put some numbers into it, each basis point move in the Eurodollar future contract is usually $25 per contract. But the nice thing about Eurodollar future contracts is that you don't have to pay anything. It's basically just put money in the margin account and that's it. So after 50 minutes, you will get $25 on average per contract. And the second thing from an economic perspective is what is giving rise to these price changes inside the press conference, such that the price inside the press conference goes in the same direction as they did around the statement release.
And in about 5 minutes.
Thanks. And in order to do that, we need this new machinery, which is let's identify which message was sent or was said during this specific minute to identify these moments. And basically, this is what we do here. So here we first have some conjecture to guide our regressions, which is if the Fed wants to communicate a message, it will do it first in the 2 times where it has the chance. First at the statement release, and second inside the press conference. So these are the only moments that the Fed communicates information. If investors do not fully understand the statement message, what will happen is that they will ask inside the press conference about clarifications about the statement, and the chairman will discuss this statement, and if they were not fully understood, the prices will still react during these words. So I think the best analogy is if you are teaching, and then your student asks you a question, you explain it some way, then you will see that maybe they understood, they will ask the same question, then you will try to explain it with different words. And as you keep explaining it, people will start understanding what you're trying to say. So basically, once we have this conjecture, we just test the following. If price move on average more in statement-related minutes than in other minutes, if we see a huge increase in trading in these statement-related minutes, and second, if prices move in the same direction as they did around the statement release. But the only thing that we need to do now is, okay, how can we identify times inside the press conference that they talk about the statement? So, and we will call this the dummy variable DT, which are instances in which they talk about that. So what we do is we aggregate these 3-second audio frames that I showed you at the beginning into 1-minute frequency. So we will have buckets of words. And then for the words that change inside the press conference, we will obtain just the noun, adjective, and verbs. And we will try to look for this inside the 1-minute text. And then we will add the extra requirement that they mentioned the word statement. So if this is the case, then we will flag it. If not, we will put a 0 otherwise. The reason why we didn't want just to search for the word statement is because some instances they could be talking about other stuff, not really related to the changes inside the statement. So these are the findings. I will not show you the tables given that I don't have time. So we see that price volatility increased significantly. Just to put some numbers, for medium Eurodollar futures, we have a price variation of 40% larger during these minutes. Trading volume, you see, for instance, for Fed Fund future 9 months, we have 50% larger trading volume during these minutes relative to the rest of the press conference. And then prices move on average in the same direction as they did around the statement release. Now, possible explanations. Basically, we have here all the explanations. And the most important one, which is consistent with our empirical results, are canonical model of information rigidities. And here the idea is if all investors are like, if the Fed communicates information, investors will try to infer that signal, but they are only able to interpret that signal with some noise. So they interpret the Fed words with noise. And once you have this case, you can aggregate all of this information and it will give you the patterns that we are able to document. And basically we reject all of these other explanations, which if you are interested, we can talk about them offline. So the conclusion is we study how central bank communication shape investor expectations. In order to do that, I think we have here the best identification, which is we align minute level accuracy, the chairman words, with financial asset prices. And then basically we document that investors only gradually incorporate the Fed messages. And once we have that, we just propose a trading strategy to see how valuable this information is. Perfect on time.
Perfect. Amazing. I think the only person in this session so far that isn't on time is me. Thank you so much, Roberto. The discussant is Miao.
Okay, let me. Oh, Roberto, can you please stop screen sharing so I can share my
Yeah,
screen?
that's important. Let me try to do stop sharing. Yeah,
All right.
perfect. Thank you.
Okay. Let me make a slideshow. All right, so it's a pleasure to discuss this very interesting paper. And let me skip the summary of the paper and get into why I enjoy this paper. I actually enjoyed this paper so much that yesterday I forgot to post my lecture slides before I went to my class, and my students complained. All right, there are a few reasons that I enjoyed this paper. First is that the paper has a very important research question. We have a few decades of research in behavioral economics and finance that collectively give us very convincing evidence that investors or economic agents in general, they deviate from the full information rational expectation benchmark. And now there's this literature in the recent years that trying to seriously study in what way and by how much on aggregates that investors or firms or households deviate from this benchmark. And this paper is at the frontier of that literature. The second reason I enjoy this paper is that the machine learning techniques that used in this paper is just state of the art. There are two main parts of it. The first is to use natural language processing technique to convert audio to words and timestamp all the words. And the second main part of it is to use some automated textual analysis to track words changed between two consecutive Federal Reserve statements. So, I mean, I never read a finance paper with machine learning techniques, that's cooler than this one. So I learned a lot myself. The third reason is that the results are surprising. So this paper is in a setting where information rigidity or underreaction to information by investors is the least likely. We're talking about Federal Reserve policy announcements. There is no more important information events on the capital market than this. So if we find any evidence, especially a strong evidence in this paper of that kind of phenomenon, it's surprising. The fourth reason that I enjoy this paper is that I agree with the author that it provides the first evidence in the literature on really the quantity of value of information rigidity. And my comments on this paper, the first two major comments are about the third and fourth points here. So let's move on to these surprising results. So my question here is, how do these results in this paper, documented in this paper, speak to macro level variations? Should we calibrate a typical macro business cycle model with information rigidity using the empirical findings in this paper? The authors argue that their findings should be a lower bound due to the relevance and salience of Federal Reserve announcements. But in the medium and the long term that a typical business cycle models focus, people have more time to respond to new information. So in that sense, perhaps we should expect a smaller impact of information rigidity when we kind of expand our time horizon from, say, 1 or 2 hours to a medium and long-term cycle. So in my mind, there might be a trade-off between identification and generalizability. The authors need to have this cute, very tight setting to have good identification. But I wonder whether we should take super seriously the exact number that the authors document to a long-term business cycle model. The second comment is about this quantification of information rigidity. So my question is, should we interpret this result as the value of information rigidity, or rather as a cost or efficiency loss due to information rigidity? And if we should interpret in the second way, then should we interpret this trading profit documented in this paper as a measure of this cost? A way to think about this is, this trading profit sounds to me like a arbitrage opportunity that institutional investors on the market haven't really exploited yet. But suppose this paper got published and all these hedge fund managers had read this paper and know about this and got this arbitrage opportunity exploited. And we don't see this trading profit anymore. How do we interpret the result of this paper? Because these hedge fund managers, they take this arbitrage opportunity away, but they don't actually have any impact on how a general investor form his or her expectation. The third quick comment is about, should we interpret the market reaction to the second press release as a uncertainty reduction, as argued by the author? Or is there any new information actually released in the second statement? I know the machine learning model might have some limitation to differentiate between pure new information versus an explanation of old information, but even anecdotal evidence would help here. And finally, I would like to make some advertisement to the accounting researchers. So accounting researchers care about how firms can effectively communicate with stakeholders through financial reporting. But how investors form expectations upon seeing new information is crucial to understand the effectiveness of firms' communication. So I would say, accounting researchers, there's a huge benefit to pay attention to the central bank communication literature. And Roberto's paper is at the frontier of this literature. Okay, that's all. Thank you.
Thank you so much, Miao. Roberto, would you like to respond to Miao? Or there's also a question from Ahmed in the chat. So choose whatever you want to respond to.
I think I have no idea. So I will just respond very quickly to both, like very fast. Just to Miao, one comment. Thanks for the presentation. I will also ask for your slides. I think they are very important for us, and we struggle with many of the points you raised. Actually, one that we were able to solve this weekend was about uncertainty. So for that, we have VIX, and we see how VIX reacted towards this statement. And we see this very strong relationship also on price in VIX, implied fall. But something very interesting is what we are finding is asymmetric effects. So when the implied vol was lower at the statement release, we see that it continues to be low during the press conference, which meant that the press conference just served to further clarify the statement. But something very interesting that we see is that during the statement, if VIX increases, which means that that statement increased a lot of the uncertainty, we see that during the press conference, it goes back down by a lot. So which means that the press conference is trying to calm investors down over that thing. But I think the other points are very well taken, and I think we should. So thanks for those. So with respect to the second question, which is on reaction to info versus investors fearing risk that the information will be released during the press conference. So we rejected the risk theory, which risk premia, which means that investors should be compensated by holding stocks inside the press conference. And the easiest way to reject that theory is basically a simple strategy that takes less risk, market risk, at the start of the press conference, which is just stay out, will do better than taking more risk. So you are taking less risk and you do better by trading on the signal around the statement. So we don't really think that the data supports a traditional risk-based asset pricing story. Meow, could you send me your slides too?
Of course, absolutely.
Thank you very much.
All right, well, thank you guys. And I think it's my turn. Hopefully you can see my slides and you can see them moving. I first of all wanted to again thank the organizers for this wonderful meeting and for accepting the paper. This is sort of, we started with the human behavior and we're now into the realm of market structure in which humans play smaller and smaller roles these days. I think actually this paper sort of makes full circle back to the panel that we had right before this session where folks started talking about using recursive learning techniques in equities. And this is probably an example of how that could be done, but of course, with an emphasis on academic research. So this paper is basically about price discovery, the process through which information gets into prices. Market structure research has been interested in this process for decades. But what we argue is we haven't really made that much progress in this area because our usual sort of workhorse techniques, such as VARs, vector order regressions, that we usually use to investigate these issues, are not particularly well suited to answer the complex questions that theory, microstructure theory, is sort of pushing us towards. So let me step back for a second and try to kind of paint a big picture, sort of an allegorical in a sense picture of what we're trying to do. So imagine the true price as an ocean. This ocean is fed by multiple rivers. They all bring water to the ocean. In other words, in our setting, they all bring information into the price. Theoretically, we know what these rivers should be. In other words, they've been predicted to exist. But empirically, up till now, we have really only researched one river, and that is orders. So we know that orders bring information into prices. That's marketable orders, limit orders. We know that part very, very well. We also know a little bit about a few other rivers, such as order sizes, state of the limit or book, time effects. We have dabbled in them, but not too well. Again, because of the lack of technology that would allow us to do that. And then there are rivers that we have never touched, even though that they are, again, have been predicted by theory. So it's, I keep making these comparisons, but given that this is not necessarily a microstructure audience, I feel like I should probably do this at the beginning. Another way to think about it is black holes in astronomy, right? There was a period of time when the astronomers have predicted theoretically that black holes would exist, but they have not been found empirically. So this is where we are kind of in market structure, in our opinion, as far as understanding the conduits through which information flows into prices. And if I were to give you a bit of a preview of our results, if I would say, let's take the entirety of that price discovery and put it in a pie chart, what we know quite well is that orange slice that you're seeing on your screens, that's the orders. We know the yellow slices sort of, so that, and that's another 40% of it. We kind of know it tangentially. And then there's the 40% of gray that we haven't touched. And again, it's been predicted by theory to be there. So our paper is basically about painting a holistic picture of this. And I just realized that I forgot to set my own timer. So let's just assume I talked for 5 minutes already. We are using this using recursive learning. Now, so I keep saying to you that there is theory that predicts that these conduits of price discovery will be there. Let me walk you through this theory really, really quickly. It goes back to the 1980s, where folks started thinking about, of course, orders, right? Orders first. And very famous theory models, Gloston and Milgram, Kyle, say, of course, the informed traders are going to use marketable and market orders. In other words, aggressively trade on their information. Then in the 1990s, the theory literature switches to realizing that, well, there's also limit orders that could be conduits for information to be incorporated into prices. And those are important because some traders don't have to trade right away. Let's say their information is long lasting. So instead of tipping the market off and trying to trade as much as they possibly can right now, they will stretch it out and try to stay under the radar of, let's say, their competition or the market makers that are watching the order flow. So that's that original theory. Then moving closer to today, theory starts adding additional variables. These are conditional variables, such as, for example, the state of the limit order book. A very famous paper by Gertler, Parley, and Rajan says that the state of the limit order book should be a significant conduit of how information gets into prices. And then there's more research on that. And then the very recent papers by, and these are all of these are theory models. Very recent theory models by Ricco, Rinti, and Seppi, and Bhattacharya and Saar start going even further and start saying that, well, actually, what also should matter is order history, time effects, state of liquidity, order arrival intensity. In other words, there are multiple rivers, and we need to start looking for these rivers empirically. Just to put some meat on this so that I'm not just listing theory papers, let me just give you a bit of a flavor of what, for example, Ayaan Bhattacharya and Gideon Saar say in their paper. What they say is that we know that informed traders are going to try and hide from the rest of the market by mimicking the behavior of the uninformed. So if we look at what the uninformed would do, we would then know what the informed would do. And what we know about the uninformed is that when liquidity is cheap, they will take it. When liquidity is expensive, they will most likely make it. So that gives us this beautiful theoretical prediction that when the spreads are narrow, the market and marketable orders are going to be more informed. But when the spreads are wide, the limit orders are going to be more informed. Testing this is rough with, again, our existing techniques. Why? Because VARs have their limitations. They're not great in capturing nonlinear relations, and there's a lot of nonlinearity in these data. They're not great capturing interactions. They're definitely not great when it comes to putting multiple conditioning variables into the same model. And as you can see, theory has thrown quite a few of these multiple conditioning variables at us. So what we do is we say, okay, let's step away from the VARs and look at what other techniques may help us with. And we use reinforcement learning. It's not necessarily the purest form of reinforcement learning. It's a derivative of it, but the concept is there. And what we're able to do is to put all of these theory predicted variables into the same model and actually solve it. And it turns out that, every theory paper written on this is right. All of those determinants, all of those conduits of price discovery, all the rivers are there. And another cool thing that we can do, and we're still working on this to bring it home, is we can rank the importance of the rivers. In other words, we can say which ones are bigger than others. In other words, which conduits bring more information into prices. And it turns out to a surprise, I would say, of many microstructure empiricists, that orders themselves, the part that we know a lot about, they of course play a very important role, but they don't certainly play the dominant role. The limit order book is pretty much equally important as the orders, and so is price history, and then slightly less than that, order sizes. So price discovery, it takes a village, in other words, to do price discovery. It's not just orders. So this is a bit of an eye-opening for some of us who have been thinking about this for quite some time. Now, I have to do a nod to the existing empirics. As I mentioned earlier, we have done a lot of work on orders. That's that 20% slice of the pie chart that was in orange on the first slide. We have done a little bit on some of the other conduits, but again, our technology has restricted us so far, and we are trying to improve upon that. At the least, we are able to uncover, or at least introduce into the mainstream empirics, about 40% of conduits that have not really been examined before. So we are pretty happy about that. Now, the data are very generic. This is your typical limit order book data. It's massive, but of course, nothing really particularly surprising there. It's from Australian Securities Exchange. We are doing 2 months of data, 20 largest Australian stocks. This is very typical for microstructure just because the data are massive and takes a while for these things to work themselves through your machinery. So this is a machine learning conference, so I'm guessing a lot of you know more than I do what reinforcement learning does. But basically, to explain our approach, I'm going to show 2 slides. The first one's going to have the formula, and the second one's going to have a picture. So how do you figure out how price discovery happens? You try to understand the permanent price impact of events that happen in the stock market. So for example, marketable orders, what is their permanent impact on prices? And of course, then you condition on their size, on the time of day they came in, on what the book was looked like at that time. So there's a lot, of course, going on, but generally we're looking at permanent price impacts here. And the way we're estimating them is by basically adding the immediate price impact, which could be temporary, by the way. It's very important for microstructure research to realize that this immediate price impact actually can go in the wrong direction from the permanent one. And then we add everything that can be expected to happen in the future, based, of course, on what the machine learned from past data. The best way I can figure to explain the approach is by showing you this little picture here. So this is a super simplistic market that doesn't exist, but probably does a decent job explaining what we do. This is a market in which you can only submit buy and sell orders, and they have to be aggressive. So simplistic, but gets the job done. So every buy order will be then followed by either another buy order or a sell order. There will be probabilities attached to those buys and sell orders. And then they will, of course, come with their own price impacts. And then the model extends that into the infinity, trying to understand what the cumulative price impact of all of that, of course, accounting for the probabilities of these events happening, will be. And the output of many of these calculations can be viewed as this sort of chart over here. So if you let me focus your attention on, I don't know if you can see my mouse, but my mouse is hovering over the upper right quadrant of this picture. So this is for orders to buy. These are market orders. So these are aggressive traders who are coming to the market to buy. And on the x-axis, you have their size. So the larger ones are here. And then on the y-axis, you have the price impact that they bring. In other words, the price discovery that comes with these large orders. Sorry, all sizes of orders. Nothing surprising here. This is just a slide to show you that the technique works. We expected to see this concave function. We're seeing it. Large buy orders have larger positive price impacts than small buy orders. This is very much expected. And then, of course, the same thing can be drawn for the sell orders. Now, by the way, to sort of justify our use of recursive learning here, you could do this with the regular conventional VARs, but they will struggle. In other words, once you start adding conditions, and in this case, the condition is order size, right? Conventional VARs begin to struggle. So this is where they can still do their job, but I am going to eventually show you the parts of the paper where we show that they cannot do their job. So the picture that I showed you on the previous slide was for market orders. You can do the same for limit orders right here. Again, very expected in a sense that individual limit orders bring less information into prices than individual market orders. This is what you can see when you compare these two pictures. But those of you who are familiar with the literature, you know that there is many, many more limit orders than market orders. So as a group, they actually contribute a lot to price discovery. Again, you can obtain this with the regular VARs, but it's not super easy. And the next slide will show you something that you cannot obtain with regular VARs. This is where we start conditioning on another variable, which has been, again, theoretically predicted, and that's the state of the limit order book. And just to make sure that everybody is on the same page here, I mentioned limit orders before. What I meant by that is that these are incoming limit orders, the ones that are arriving right now, and they do bring some information to prices as they come. What I'm looking at now in this picture is the state of the book. And in other words, these are limit orders that are already there and have been there for a while. So, I mean, a while in modern markets could be just a couple of microseconds, but they're not fresh. And what I hope you can see here, oh, well, I should probably explain what this picture is showing before I say what you can see here. So the gray line is that average case that we saw on the previous slide, right? So that's the average. Then the green is the same thing, but when the book, the limit order book is heavily imbalanced towards the buys, okay? And the red is when the book is imbalanced towards the sells. So a couple of cool things come out of this. First of all, well, clearly the book matters. Second of all, it seems that sometimes the book matters so much that it overpowers the information that is brought to the market by the orders themselves. to give you an example of that, so this is a large, aggressive order to sell, and it has, as you can see on this axis, a positive price impact. In other words, you see a large order to sell that wants to sell right now, and you infer from that that the actual price movement, permanent price movement after that order executes is going to be positive. This has not been seen in empirics before. This has been predicted by theory that says order book should be very important. And this is basically what this result shows, that yes, it's in some cases, the order book is more important than the orders themselves. Now, I don't want to sort of run you through every piece of theory we test because it gets repetitive. Let me do one more and then move on to that ranking that I also mentioned earlier. So one really cool new theory that just came out a few months ago is a working paper theory model by Ayan Bhattacharya and Gideon Saar, who basically say, look, we haven't really been able to model dynamic order books too well before. This is theoretically. But we are actually going to try a slightly different approach, and we're going to give you some new predictions. And their predictions are, as I mentioned earlier, that of course we know that the informed are going to try to mimic the behavior of the uninformed when they can. And because of that, when liquidity is cheap, marketable orders are going to be more informed than when liquidity is expensive. And the other way around for the limit orders. And this is, again, something that you cannot easily or at all test with VARs, but you can do with this RL framework. So as you can probably see here in this picture, market orders, when the spread is narrow, in other words, when liquidity is cheap, they are more informative. They bring more information into prices than when liquidity is expensive, exactly what is predicted by theory. And the picture flips for limit orders. Limit orders are much more informed when the spreads are wide. So we think that every theory that's been written so far is going to be happy to see what we do. But we also want to do something else. We want to understand the holistic picture of everything here. In other words, there are all these rivers, right? There are all these conduits that are theoretically predicted, but which ones are more important? Which ones bring more information into prices? And our technique, we use MDA to sort of extend our approach, but basically machine learning allows you to do that. And as I mentioned earlier, to our surprise, although again, theoretically this has been suggested, we show that the book is extremely important. It rivals the order arrivals that we have researched so much in the past, and so does price history. This is something I think that many empiricists didn't necessarily know to what extent these things mattered, and we hope that if folks agree with our approach, then this will shed light on issues that we haven't been able to really address before. So to conclude, our old technology in market structure research, which is VARs, is not great when it comes to complex systems that theory has predicted for us. We have to do something else. And to do it, we use machine learning, one of the machine learning techniques. We show that about 37% of all price discovery conduits have never been touched by empirics. And then there's another 40% that have been touched very lightly because of, again, technology is not there for us to do it. So we hope that this is informative for those who care, and that more and more folks will start using these techniques to push the literature forward. Thank you very much. Now I see where we are on time, and looks like we're okay, sort of. So Roberto, please take it away.
Yeah, thank you very much. Let me just find, thank you. And then, so I really like this paper, and that's why I'm very grateful that the organizers asked me to discuss this paper. And the reason why I like it so much is because it's after a very important question, which is what information gets incorporated into asset prices. And so basically, this paper provides a very comprehensive study And I think the main takeaway that I took away from this paper is, okay, now what explains price impact? And basically the authors have a very clear order, or a pecking order of price discovery conduct. So we see that the current state of limit order explains some fraction, individual order submissions and cancellations, price order history, order size, and time effects. So basically what this paper does is putting some numbers on all of these rivers that Andre talked about. And for me, that's the main takeaway. And so here it seems like this seems to be a quantitative paper to try to put numbers into these rivers. And in order to do that, they propose a new method called reinforcement learning algorithm. And the nice thing about this reinforcement learning algorithm is that it works very well when we condition on multiple conditional variables. And it works perfectly for non-linearities, as you can see with the graphs that Andre showed us. So let me first, I have 3 comments and then a minor comment. The first one is, I think I would like to see more intuition about the model, about the algorithm. So Andre showed us this equation, which basically is the permanent price impact of action A in state S is equal to QSA. So here we have 2 actions, buy and sell, and we have 3 states: negative imbalance, no imbalance, positive. So basically here you have the permanent price impact of action A in state S is equal to the immediate price impact of an action A in state S. So basically you have to put some numbers into it. So here the authors take as the immediate price impact the changes in the quote midpoint from action A in state S, and then just take the average across all observations, if I understand it correctly. So in this scenario, you have to estimate 6 parameters. So once you estimate this immediate price impact, what you have to do is, in a recursive fashion, just until convergence, back out what is this value here. For that, you first need a discount factor, which the authors fixed to 0.99. And then they have to compute this transition probability matrix, which is basically the number of times you go from state S action A to state S prime to action A. So in this example, you have to estimate 36 parameters. So I think here it will be great if you just give us more intuition where it's coming from. And also, for instance, some questions that I just by reading it from an asset pricing perspective was, okay, why is not conditioning on the state on the firm characteristic? I would expect that this R would change more depending on the characteristic of the firm. If a small firm is a growth firm, or I don't know, from an asset perspective, I think firm characteristics are informative about this, or maybe conditioning on this state would help you to do that. The second one, why don't condition economic periods? When stress in the financial sector are high or low, you see that this R will change more or not. If risk premium is high, then I think a market buy will change more relative to other periods. But I think with your model, it's quite easy to do. Is just increase the number of states. You just have a state here, negative imbalance for a small firm, negative imbalance for a large firm. I think just if you give us more intuition, it will be just more easy to digest that what you're doing. It makes sense. The second one is because you have a quantitative paper, I think maybe the noisy estimates of this will affect your permanent price impact. And here you are dealing, I don't know what's the frequency, but I guess now that you mentioned it's milliseconds, maybe computing average returns over a very short time period could be that this R is quite noisy, and that could affect the numbers that you put into these different rivers. I'm just not sure. It could be just that it's nothing, but for me, estimating returns, we are very bad at doing that. And maybe that is affecting the quantitative numbers that you are selling us. And I think, or the main takeaway for me. The second one is, why not knowing what happened in state -1 and the action you took about state A -1, in addition to state S and action A, would be also informative about S prime. It's just adding an extra state. It might be not necessary, but I think just trying to sell a little bit better, provide more intuition about the model, I think it will kill all of these questions, and we will trust the numbers that you put to these different rivers. And then where does gamma come from? I think this is a quite standard number, but then I was just curious, would the pecking order change if we change something about this? Or I don't know. I think some more robustness checks there would be quite useful for the reader. And the second one, I think once you provide intuition about the model, I think I was hoping to see a little bit more about that it's a good model. I think something that I really like is that you showed that it outperforms the VAR framework. And I was just curious if it's able to outperform other models. And if you, I know that it takes a lot of time to estimate these models, but I think if you could do even a horse race and just show, okay, it's actually outperforming these 3 different models, then by doing that, I think it will just, we will just buy your numbers more. And then once you are able to do that, I think it will be quite nice, given that what you showed us, like nobody has done this before, and you are able to provide even numbers to the different conduits. So in order to do that, I think the best thing is just show us first that your method, it's quite robust and has economic intuition, which will put more faith in the numbers that you show us. The third thing, I think something that would be very nice, once you show us that the model is good, it will be also very nice that you show us where the model fails. Maybe it's when the number of stocks is very large, you are considering only 20 stocks, but maybe not, because I think once you average out, it's not important. Maybe where your model will have more troubles if you are able to increase the number of actions and states. And it could be that you will not find numbers in some of these once you do the grid on the states. And I think for me, this is valuable and important to the literature in case we want to use that model is just trying to see where we will face problems. And if you're able to document that for us, I think it will be great. And we can just cite saying, okay, I think with this particular data set, it will be nice. And then this is a very minor comment, which I'm not very familiar with, but it was like you provide robustness with respect. In order to compute these numbers at the end, you use the mean decrease accuracy. For those that are not familiar, it's a metric that expresses how much accuracy the model loses by excluding each variable. And then the more the accuracy suffers, the more important the variable is for the successful classification. I think here my main concern with this method is that it requires a value for the true predicted price impact, which in turn is measured with noise. And maybe that noise is affecting this correlation that you're documenting. Overall, I think that's it. I think I really like the paper. I think the result that you were able to show us, which rivers are more important, it's a fascinating finding in this paper. And I think my only suggestion is just to strengthen the paper such that these numbers appear more strong than they are. And yeah, that's it.
Thank you very much, Roberto. I know we are about 3 minutes over time, so I'll be super quick. I really appreciate the comments. You'll be happy to know that we have been working very hard on actually explaining in excruciating detail what we do. So the next version is going to hopefully do a much better job than the version that you saw is doing, because yeah, that's the question we get from everybody. Given that this is a very new technique for pretty much everyone in our field, this seems to be what people really want to know. So thank you for all of these comments. I really appreciate it.